If you are new to investing, ETFs can feel confusing at first. People talk about index funds, expense ratios, diversification, dividends, sectors, bonds, and ticker symbols, like you are already supposed to know what all of it means. But the basic idea is simple. An ETF lets you buy a basket instead of betting everything on one company. That basket might hold hundreds of stocks, a group of bonds, a specific sector, or a certain investing theme. This is Market Ghost, stock market strategy without the hype. In this video, we are breaking down ETF investing for beginners, what ETFs are, why investors use them, how they compare to individual stocks, what risks still exist, and how to think about ETFs inside a simple portfolio. This is not a recommendation to buy any specific fund. The goal is to help you understand the tool before you use it. Educational content only, not personalized financial advice. Always do your own research.
ETF stands for Exchange Traded Fund. That name sounds complicated, but it is easier if you break it into parts. It is a fund, which means it can hold a collection of investments. It is exchange traded, which means it trades during market hours like a stock. So instead of directly buying every company inside the fund, you buy shares of the ETF. Some ETFs are broad. They may track a major market index or a wide group of companies. Some ETFs are narrow. They may focus on one sector, one theme, one country, one asset class, or one strategy. The important beginner idea is this: an ETF is not automatically safe just because it is an ETF. You still have to know what is inside the basket. Market Ghost rule: never buy the wrapper without understanding the contents.
Many beginners are drawn to ETFs because they can make diversification easier. If you buy one individual stock, your result depends heavily on that one company. If that company has weak earnings, bad management decisions, legal problems, competition, or changing investor sentiment, your position can be hit hard. With a broad ETF, your money is spread across many holdings. One company can still matter, especially if the fund is heavily weighted toward the largest names, but the risk is usually less concentrated than owning one stock by itself. That is why ETFs can be useful for building a portfolio foundation. They can give you broad exposure without requiring you to research every single company from scratch. But easier does not mean automatic. You still need to understand the fund, the risk, the cost, and the role it plays in your plan.
Think of an individual stock like owning one business. If that business does well, you may benefit. If that business struggles, you feel it directly. An ETF is more like owning a basket of businesses or assets. You are usually accepting less company-specific risk in exchange for broader exposure. This does not mean ETFs always beat individual stocks. Some individual stocks can outperform dramatically, but finding those winners consistently is hard, and holding them through volatility is even harder. For beginners, the question is not which one is cooler. The question is which one fits my knowledge, risk tolerance, and time horizon. If you do not yet know how to analyze individual companies, a broad ETF can be a more structured place to learn portfolio building.
Not all ETFs are built the same. A broad ETF might hold companies across many industries. Its goal is usually wide market exposure. A narrow ETF might focus only on technology, energy, real estate, dividends, artificial intelligence, small companies,
international markets, or another specific theme. Narrow ETFs can look exciting because they feel more targeted. But targeted exposure also means targeted risk. If the theme falls out of favor, the fund can struggle. If the sector becomes overvalued, the fund may be more vulnerable. If the ETF owns a small number of holdings, it may be less diversified than beginners assume. Market ghost rule. The more specific the ETF, the more you need to understand the specific risk.
Every ETF has costs. One common cost is the expense ratio, which is the annual fee charged by the fund. The expense ratio may look small, but costs matter because they reduce your return over time. Lower costs are not the only thing that matters, but beginners should always check them. You also want to understand what you are paying for. A simple broad index ETF may charge a low fee because the strategy is straightforward. A more specialized or actively managed ETF may charge more because the strategy is more complex. Higher cost is not automatically bad, and lower cost is not automatically best. But you should know the cost and why it exists before buying. Market ghost rule: fees are quiet, but they are real.
One of the most important things to check before buying an ETF is the holdings. The holdings tell you what the fund actually owns. This matters because two ETFs can sound diversified but behave very differently. One fund may spread weight across many companies. Another may be dominated by a small group of large holdings. Concentration is not always wrong. Some investors intentionally want exposure to certain companies or sectors. But beginners should understand when a fund is concentrated because concentration changes risk. If the top few holdings make up a large part of the ETF, the fund may move more like those companies than the name suggests. Market ghost rule: the ETF name is marketing. The holdings are reality.
Some ETFs focus on dividends or income. These can attract investors because the idea of regular cash flow feels stable. But dividend ETFs still carry risk. A company can cut a dividend. A fund can lose value. A high yield can sometimes be a warning sign, not just an opportunity. Income-focused ETFs may also behave differently from growth-focused ETFs. For beginners, it is important to understand total return. Total return includes both price changes and income. A fund that pays dividends can still lose value. A fund that pays little income can still grow in price. The question is not just how much does it pay? The better question is, what role does this ETF play in my portfolio?
ETFs trade during the day, which can be convenient. But that convenience can also tempt beginners into overtrading. Because ETFs move like stocks on the screen, it is easy to start watching every small price change. But if your strategy is long-term, daily price noise can distract you from the bigger plan. Liquidity also matters. Some ETFs trade heavily, while others trade less often. Lower trading volume can sometimes mean wider bid-ask spreads, which can make buying and selling slightly less efficient. For most beginners, the bigger issue is not becoming an ETF day trader by accident. The tool is flexible, but your behavior still has to match your strategy. Market ghost rule: easy to trade does not mean you need to trade often.
A simple portfolio might use ETFs as the core foundation. That core can provide broad exposure, while smaller satellite positions can be used for specific ideas if the investor understands the risk. For example, someone might use diversified funds as the foundation, then keep individual stocks or sector funds as smaller additions. The point is not the exact formula. The point is structure. Without structure, Beginners often collect random tickers. One ETF here, one trending stock there, one theme they saw online, and suddenly the portfolio has no clear purpose. Every ETF should have a job. It might provide broad market exposure, international exposure, bond exposure, dividend exposure, or a specific theme. If you cannot explain the job, slow down.
Here are common ETF mistakes beginners should avoid. Mistake 1. Assuming every ETF is diversified. Some are broad, some are narrow, some are highly concentrated. Mistake 2. Only looking at past performance. Past performance can show what happened, but it does not guarantee what comes next. Mistake 3. Ignoring fees. Costs may look small, but they still matter over time. Mistake 4. Buying overlapping ETFs. If multiple funds own many of the same companies, you may be less diversified than you think. Mistake 5. Chasing themes. A popular theme can become expensive, crowded, or volatile. Market ghost rule. Simple does not mean careless.
Before buying an ETF, run a simple checklist. What does this ETF hold? Is it broad or narrow? What is the expense ratio? How concentrated are the top holdings? Does it overlap with funds I already own? Does it match my time horizon? What role does it play in my portfolio? What risk am I accepting? If you can answer those questions, you are no longer just buying a ticker. You are making a more informed decision. ETFs can be powerful tools for beginner investors, but the tool only works if the strategy is clear. Do not chase the fund. Understand the basket. This is Market Ghost, stock market strategy without the hype. Educational content only, not personalized financial advice. Always do your own research.